Silver did not collapse because demand vanished or supply suddenly surged. It fell because a mechanical rule change triggered forced selling across leveraged futures positions in minutes. A margin hike hit the silver futures market, instantly raising collateral requirements and forcing traders with leverage to either post cash immediately or liquidate positions without hesitation. When thousands of traders face margin calls simultaneously, markets do not negotiate. They cascade downward as brokers liquidate positions automatically at whatever prices liquidity allows. This kind of drop is not driven by fear or opinion, it is driven by necessity, because margin rules transform optional selling into mandatory selling under extreme time pressure. Futures contracts control massive silver exposure with relatively small capital, meaning small rule changes can unleash enormous paper selling disconnected from physical metal movement. As selling accelerates, stop losses trigger, algorithms react, and liquidity thins, creating the sharp cliff-like price action silver is infamous for during margin events. Thin market conditions amplify the damage, because fewer buyers are available to absorb forced selling when margin changes strike during holidays or low-volume trading sessions. The key lesson is simple but painful. In silver, you are not only trading supply and demand, you are trading leverage rules that can change overnight. Exchanges raise margin to protect themselves from volatility risk, but that same action directly reduces buying power and mechanically pressures prices lower. This process disproportionately impacts smaller traders who cannot wire fresh collateral quickly, while large institutions can post funds within minutes. As price falls, liquidation feeds on itself, because lower prices increase margin stress, forcing even more traders to exit positions involuntarily. During these moments, enormous volumes of paper silver change hands without any corresponding movement of physical bars, coins, or industrial supply. Futures prices act as benchmarks, so paper selling can drag visible prices lower even if physical demand remains firm and inventories remain tight. This creates a confusing divergence where charts scream collapse while physical buyers quietly continue accumulating metal at discounted paper prices. Such events feel unfair because structurally they are, as the least liquid participants, are forced out first, regardless of long-term fundamentals. History shows this pattern repeating. Silver rallies aggressively, margin requirements tighten, and leveraged positions are flushed from the system. These flushes are not random accidents. They are mechanical outcomes of leverage interacting with volatility and rule-based risk controls. The result is often a transfer of exposure from weak hands using leverage to strong hands holding cash and physical metal. This is why margin crashes can be both terrifying and constructive, violently clearing unstable positions that would otherwise remain vulnerable. Understanding this structure turns chaos into clarity, revealing that today's crash was a rules event, not a rejection of silver itself. After the forced liquidation passes, markets rarely calm immediately. Instead, volatility intensifies as price whipsaws, and traders struggle to regain balance and confidence. This post-liquidation phase exists because selling pressure may be exhausted, but trust is damaged, and liquidity providers demand wider spreads before committing capital again. During this window, price movements become deceptive. Sharp rebounds lure traders back in, only for sudden pullbacks to punish impatience and oversized positions. These violent swings are not evidence of new fundamentals. They are symptoms of a market digesting stress after leverage has been violently purged. Professional traders understand that margin events reset positioning, changing who holds exposure and how much risk remains embedded in the system. When leveraged longs are flushed out, remaining participants are typically cash-backed, longer-term oriented, and far less sensitive to short-term volatility. This shift in ownership often stabilizes the market beneath the surface, even while visible prices remain erratic and emotionally charged. The critical question becomes whether physical demand continues absorbing metal at lower paper prices or retreats in response to broader economic stress. If physical buyers remain active, paper weakness becomes a temporary distortion rather than a lasting signal of declining value. This is why physical premiums provide insight no candlestick pattern can offer during periods of structural dislocation. When premiums hold or rise while futures fall, the physical market is quietly contradicting the narrative implied by price screens. Such divergence suggests scarcity remains unresolved despite the dramatic liquidation occurring in financial markets. Inventory data reinforces this message by revealing whether metal is actually leaving warehouses or simply changing paper ownership. A true bearish shift requires inventory rebuilding, not just falling prices driven by rule-based selling. Delivery behavior adds another layer of evidence, showing whether traders are demanding metal or choosing to roll contracts forward. High delivery demand during price weakness indicates confidence in long-term fundamentals rather than speculative excess. These signals matter more than headlines because they reflect decisions made with real capital and logistical constraints. In contrast, social media panic and news narratives amplify emotion without providing meaningful insight into underlying supply conditions. Understanding this distinction prevents emotional reactions that often lock in losses precisely when opportunity quietly emerges. Margin events punish speed and leverage but reward patience, preparation, and respect for how market structure truly operates. To understand silver's behavior, you must zoom out beyond daily charts and recognize how its small market size magnifies every structural shock. Silver trades in far thinner volumes than major assets, so forced selling does not require massive capital to overwhelm available bids. This fragility makes silver uniquely explosive, capable of extreme upside during accumulation phases and brutal downside during margin-driven stress. Because silver is small, leverage plays a larger role, amplifying both enthusiasm during rallies and damage when rules abruptly tighten. This is why silver rarely tops quietly. It is usually interrupted by a mechanical event rather than a gradual loss of interest. When leverage dominates participation, price no longer reflects pure fundamentals. It reflects the stability or instability of positioning. Margin hikes function like a circuit breaker that selectively targets leveraged exposure without touching underlying physical demand. This selective pressure explains why physical buyers often appear strongest precisely when futures prices look weakest. Industrial users are not trading charts. They are securing inputs required for production schedules, contracts, and infrastructure commitments. These buyers respond to availability and reliability, not intraday volatility or social media sentiment. When paper prices fall sharply, procurement desks often accelerate purchasing to lock in supply at temporarily discounted benchmarks. This behavior quietly absorbs metal while financial participants debate narratives and timing. Over time, sustained physical buying reduces available inventory, tightening conditions beneath the surface. As inventory tightens, the system becomes more sensitive to any disruption, whether geopolitical, logistical, or regulatory. In such an environment, paper-driven sell-offs do not resolve imbalance, they merely delay confrontation with physical constraints. Eventually, price must reconcile with reality through higher premiums, delivery stress, or renewed futures strength. This reconciliation does not happen instantly because physical logistics move slower than financial transactions. Vaulting, transport, refining, and financing introduce friction that stretches resolution across weeks or months. During this lag, markets often misprice risk, mistaking temporary paper weakness for lasting fundamental change. Investors who understand this delay can avoid reacting to noise while positioning for structural resolution. History reinforces this lesson repeatedly, because silver has demonstrated the same structural behavior across multiple decades and vastly different macroeconomic environments. In each major silver spike, enthusiasm accelerates price until leverage becomes excessive and rule changes abruptly reset participation. The famous silver episode of the early 1980 seconds was not ended by exhaustion alone, but by tightened trading rules that crushed leveraged exposure. Later, narratives blamed greed and speculation, yet the mechanical trigger was a sudden restriction on buying power. The same rhythm reappeared in 2011, when repeated margin hikes broke silver's rally into a sequence of violent sell-offs. Each increase forced traders out in waves, creating a stair-step collapse rather than a single decisive top. These episodes illustrate that silver does not fail quietly, it is interrupted by structural intervention. Understanding this pattern prevents confusion when price reverses rapidly without any meaningful change in physical conditions. What looks like a collapse is often a controlled release of pressure within a leveraged system. This does not imply conspiracy. It reflects incentives, risk control, and institutional self-preservation. Exchanges must protect clearing members, but protection actions inevitably influence price direction. When markets become crowded on one side, margin tools reduce exposure faster than sentiment ever could. The critical insight is recognizing who benefits first when forced selling hits the tape. Sellers lose discretion, while buyers with capital gain negotiating power and patience. This transfer of control shapes the next phase of price discovery. After a purge, remaining positions are smaller, stronger, and less vulnerable to sudden liquidation. That stability allows price to rebuild if fundamentals continue applying upward pressure. Conversely, without fundamental support, price stagnates rather than collapses further. This distinction separates structural resets from genuine trend reversals. Investors who recognize the difference avoid mistaking mechanical events for permanent damage. Beyond trading mechanics, silver's importance is rooted in its role as a critical industrial input embedded deeply across modern technological systems. Silver is essential for solar panels, where its conductivity and reliability directly affect energy efficiency and long-term system performance. Electric vehicles rely on silver for power electronics, battery management systems, and high-current contacts that must perform flawlessly. Data centers consume silver through connectors, switches, and thermal components, supporting the digital backbone of the global economy. Grid modernization projects depend on silver-intensive equipment for switching, protection, and control across expanding electrical networks. This industrial demand is structural, not speculative, and does not disappear because futures traders liquidate positions. Demand is locked into manufacturing pipelines, contracts, and capital investment cycles that operate independently of daily price volatility. On the supply side, silver is primarily mined as a byproduct of other metals, limiting its ability to respond quickly to higher prices. Copper, zinc, and lead production decisions determine much of global silver output, not silver prices alone. This creates an inherent rigidity in supply that makes prolonged deficits difficult to resolve quickly. When demand exceeds production, inventories are drawn down rather than replenished. Inventory drawdowns reduce system resilience, increasing sensitivity to disruptions and shocks. As buffers shrink, even minor logistical or geopolitical issues can have outsized price consequences. These pressures build quietly beneath the surface, often masked temporarily by paper market volatility. Margin-driven sell-offs do not add supply, they only change who holds paper claims. Physical shortages cannot be solved through liquidation, only through time, investment, and production. This disconnect explains why repeated paper crashes fail to permanently suppress silver prices. Instead, they often delay repricing while tightening physical constraints. Over time, unresolved deficits force the market to adjust through higher premiums or stronger futures prices. Structural demand and constrained supply form the foundation beneath silver's recurring volatility. Geography and policy further complicate silver's balance because mining, refining, and consumption are spread unevenly across regions with different priorities. Large portions of global silver refining and manufacturing capacity are concentrated in Asia, close to end users rather than futures exchanges. When physical silver flows toward manufacturing hubs, it becomes unavailable for settling paper claims elsewhere. This geographic separation increases the risk of disconnects between futures prices and real-world availability. Export controls, tariffs, or domestic prioritization policies can tighten supply without warning to paper markets. Such policy shifts do not announce themselves through price charts. They emerge later through delivery delays and rising premiums. These stresses accumulate quietly, often ignored, while traders focus on short-term price fluctuations. Futures markets are efficient at trading expectations, but inefficient at reflecting logistical friction in real time. As a result, paper prices can temporarily suppress signals that only appear once physical constraints bite. When delivery demand rises, paper markets are forced to reconcile with physical reality. This reconciliation often occurs abruptly, reversing earlier declines that were driven purely by financial mechanics. Margin events accelerate this process by transferring metal exposure toward participants capable of taking delivery. Over time, this increases the proportion of claims backed by genuine supply intent rather than speculative leverage. As speculative excess fades, price discovery becomes more sensitive to actual availability. This is when volatility shifts direction, catching late sellers off guard. Markets rarely reward those who react fastest to fear, but often reward those who prepare for constraint. Understanding silver requires patience across cycles, not prediction of single-day price movements. Structural forces operate slowly, but they dominate outcomes once leverage noise fades. This is why silver repeatedly shocks both bulls and bears who ignore market mechanics. The metal itself remains unchanged, while the structure around it determines short-term chaos. After a margin shock, psychology becomes the battlefield, as narratives shift faster than facts and certainty replaces analysis. Headlines declare tops and bottoms because confidence sells better than nuance during periods of stress. This narrative flip is designed to provoke emotional decisions while uncertainty is highest. Fear-driven selling often occurs after the mechanical damage has already been done. By the time panic dominates, leverage has largely been purged and risk has quietly decreased. This timing mismatch causes many traders to sell near lows rather than during excess. Professional participants understand this psychological pattern and position accordingly. They do not need prices to collapse forever, only long enough to acquire exposure cheaply. This creates the illusion of certainty precisely when probability is shifting. Psychological pressure amplifies volatility far beyond what fundamentals justify. Separating emotion from structure is essential to navigating these environments. Structure tells you what can happen. Psychology tells you when people are likely to make mistakes. Margin events exploit this overlap by compressing time and decision-making. Those unprepared for sudden rule changes are forced into reaction rather than strategy. Preparation does not guarantee profit, but it prevents catastrophic error. Risk management is not avoiding volatility, it is surviving volatility intact. This survival allows participation when opportunity emerges. Markets reward those who remain solvent and rational during stress. Silver tests this discipline repeatedly because of its structural volatility. Those who learn its lessons stop fearing its moves and start interpreting them. When the noise fades, the final truth remains unchanged. Silver's fundamentals are written in atoms, not opinions or trading rules. No margin memo can increase mine output, replace depleted inventories, or remove silver from industrial necessity. Rule changes can delay price discovery, but they cannot erase physical demand embedded in global infrastructure. This is why every margin-driven collapse eventually hands opportunity to those focused on reality rather than screens. The challenge is enduring volatility without confusing distortion for destruction. Timing remains uncertain, but direction is governed by supply, demand, and availability. Structural deficits resolve through repricing, not through forced selling. Those who understand this wait for confirmation in physical signals, not headlines. Premiums, inventories, and delivery behavior tell the story price temporarily obscures. When these align, paper prices are forced to follow. Silver's volatility is not a flaw. It is the consequence of a small market carrying enormous strategic importance. This combination ensures future stress events will occur. The lesson is not to predict each one, but to recognize them when they arrive. Margin shocks punish leverage, not conviction grounded in physical reality. Survival through chaos is the prerequisite for benefiting from resolution. This is why silver separates speculation from understanding. Those who rely solely on charts see randomness. Those who study structure see patterns. Over time, patterns become confidence, not certainty, but informed expectation. In silver, patience is not passive, it is strategic positioning. And when the system finally reconciles, it rewards those who waited.